Welcome to the Daily Update. This is Being Prepared Friday, July 22nd, where we'll look at the action in the market today and then see how things look for Monday, July 25th. And it shouldn't be really surprising that we saw a pullback. We didn't quite give back all of the gains on Friday that we picked up on Thursday, but pretty close. We were down 0.93%. What we need to see now is, okay, we've worked off a bit of this short-term extreme readings. I wouldn't even say overbought at this point, but we fell back, and I'll show you the charts to back that up. Now, what we need to see next week is some pretty good follow-through buying, and I state that numerous times throughout the slides. But that's what we really need to see right now, okay? We gave some back, we worked it off, we made people a little more anxious about things, but now where do we go from here? So let's go back and talk about Friday. Right at the open, we had a little bit of a higher open, and that's where the high was set for the day. But selling quickly came in and took prices negative. As the day went on, we fell below the daily pivot at 39.75, and we went down even below S1 at 31.95. Going into the close, we saw some buying come back in late in the day, and that can be somewhat positive. It took prices back above S1, and we ended up being, as I said, down 0.93%. Volume was below average. Now, you can twist that a couple of different ways. We've been seeing below average volume for quite a bit of the summer. We saw above average volume on Thursday. How much of that was short covering if you're looking more negatively right now? Those are people in short positions that have to buy to get out because suddenly they're losing. Or you could say we had a strong update on an increase in volume. All right. Then you could say the average volume on Friday was below because we saw a decline, or we're just going back to what's been the norm lately. So anyway, you can twist that a couple of different ways. The technicals, they're still holding up for the most part. Some of our short-term indicators are working off some of their extreme positive readings, not all of them. Inflation and interest rates, and that's going to be the story this week unless something else really breaks, because the Fed is meeting this upcoming week, and they're probably going to have a 0.75% raise in interest rates. That's what it's looking like it's going to be, at least right now. Now, something could come out Monday or Tuesday before they make their announcement on Wednesday to throw a real wrench into that fire. But right now, it's looking like it's going to be 75 basis points. We have a whole list of geopolitical concerns, and it's the same list that I keep talking about. Earnings, as the companies have been coming out, some days they're more positive, some days they're negative. Some days they come out with a crummy report and the stock goes up. They come out with a really good report and the stock goes down. It's really hard to predict those things before they happen. The big deal now is recession fears. Whether we're going into a recession, whether we're already in a recession right now, we'll get some more data this week. The Fed will make some statements about what they see as the problem, and the market can then have a chance to react to that. So what are some comments? We saw a pullback after 3 up days. And the short-term overbought, that's STOB, it's working itself off. And I wouldn't even go that far necessarily, but we need to see buying come back into the market if we're going to resume this upward movement that we've been seeing, this positive backdrop that has been developing, and it's still hanging in there. The sector rotation, it's still holding up, especially with discretionary. The other areas that we watch, and I'll show you the charts, they were flat on Friday. Discretionary still has continued to advance, so that could be taken as a positive. The 10 to the 2 and the 10 to the 5 yield curves, they're still inverted. We're still watching the 10 to the 3 month, and I'll show you the chart. We had the IHS market manufacturing PMI. This was manufacturing, and it came in at 52.3. Whenever we drop below 50, that means the economy is contracting. As long as we stay above 50, the economy is at least growing, where the prior reading had been 52.7. That was weaker than what they expected. Also, for the services PMI that came out, the preliminary reading was 47. That was quite a bit lower than what they thought. And the prior reading had been at 52.7. So we're showing a contraction now in the service areas according to this economic report. Our trend is still not trending. The ADX is still below 20. I've switched the bias over to mixed because it was not quite a percent down day, but still, a respectable down day. We have to be careful of this. There are some things developing, but are we going to go really strong up from here, or are we going to linger higher from here? That's why we have to be careful of this. We can see some down days, even if the backdrop is still looking more positive. The momentum going out 2, 3, 4, 5 days, I still have that set at positive. Even though we had a down day on Friday, we're still looking at a pretty positive backdrop right now. Let's go and look at sentiment. It declined a little bit. We were getting closer to neutral. Now we're down to 39, and here is the chart showing where we have dropped down a little bit. And that's to be expected. On an up day, this tends to go up. On a down day, this tends to go down. Then here are some Isabel Net charts. And I've tried to include some of their headlines in here because some of these charts can be a little hard to figure out by just looking at them. They use acronyms that they don't define what they are. And so sometimes when I feel it's more helpful, I'll try to include the headline here, where this is the LEI. This is what came out on Thursday, and it decreased by 0.8%. That's what I said in the video. And this is suggesting that we're around a recession at the end of this year or early next year. And that appears to be increasing. Here's the LEI, the blue line, which is starting to come down. In a good, healthy environment, you'll want to see that really go up. And then here, this is just the LEI, the coincident economic index, which it's still continuing to advance up higher. But really, it's the blue line that we pay attention to the most. Here are the small caps. And this has been a little bit of a problem. They underperformed again on Friday. So they're not really holding up all that well. But this suggests that they're historically cheap when you compare them to large caps, specifically the Russell 1000. That looks at bigger market cap stocks. And it just shows here there's a blue line where we've really been going down on a relative basis. So those folks that like small cap stocks, you want to get in at a really low price and then ride it until it goes to a much higher price, or maybe even turns into a mid cap or eventually into a large cap. Microsoft started as a small cap and it didn't stay there for very long. But a lot of these big name companies, they started out small and then grew to large. This could help a little bit because if they're cheap and more value-oriented investors want to get into those stocks and ride them out, that's going to help produce a bounce in the small caps, and that could really help out the rest of the market. Here's another headline. This just shows the E-mini futures market depth. And if any of you day trade, which I doubt if you watch these videos, but these are contracts that are highly leveraged, and you can participate in the S&P movement, either upside or downside. When we're really ripping to the upside, this has a tendency to really advance. You can see 2020 and then really going up. Well, we're seeing it really going down right now. And this is what they call a depth chart. It just means there's not an awful lot of people participating in this right now. Maybe they got burned. Maybe they went long and lost a lot of money and they can't participate anymore. Because if you're a day trader, this is probably the area where you started out. And there's all these programs out there, all these get rich quick schemes out there telling you that you can make all this money with any kind of E-mini contract, specifically the S&P, because it's very liquid. But people get in there, they don't really understand what they're doing, and they can lose a lot of money very quickly. Here is just the headline because it's pretty long. About once a month or so, I show the truck tonnage against the S&P 500, and it was at 2.7 the last time we saw this. And it says that they represent 72.5% of the U.S. freight and serve as a barometer of the U.S. economy. It just shows that the stock market tends to increase in line when this is going up. And the inverse is also true. Then they have a little disclaimer at the bottom that says this is not a leading indicator, even though kind of up above they kind of said that. But the chart is very interesting because it shows how the U.S. stock market tends to follow the physical expansion and contraction of the economy. Here's the chart, and we can blow it up kind of big. This is the S&P, the purple line, where we went up at the end of 2021 into the early 2022, and we've been coming down. We've been bouncing up a little bit. Well, here is the truck tonnage index, and it's also been increasing. These lines tend to not get very far apart from each other. So does that mean the S&P is going to keep going down, or the truck tonnage index is going to keep going up, or a combination of the two? We'll have to see how that plays out, because we have a lot of supply issues. We have a lot of economic issues and so forth that could really keep this index, the orange one, from really having problems advancing. Then this is the equity allocation. It just shows that most folks, according to Bank of America, as a percent of their assets under management, they are still heavily weighted in stocks. So they haven't really ditched them yet. They did get out during the COVID plunge, and there's other times when they've been really underweighted, like we saw back in 2009, but we're still overweighted right now. This is looking at M2, the money supply, the rate of change of the money supply, and then they advance it 12 months. You know how I love those charts against gap earnings. And I don't see a real strong correlation here. They have a tendency to kind of go up together, but here they diverged along this. And now it's really showing how the rate of change for the gap earnings has really been decreasing, while the money supply really has not been decreasing all that much. I'm not sure really what to take from this, other than it's kind of interesting. But when you start shifting things around, I'm not a big believer in that. I think it's interesting. I think we can get some insight, but to base decisions around that is not something that I have found to be very effective. Then we have US existing home sales, the median price, man, they're just continuing to go up. And eventually they're going to get to the point where, see, a lot of people can't afford them now, but eventually most people are going to get to the point where they can't afford them. And then we're going to really start to see housing prices come down. Here's the active asset manager survey for the week. It did bounce up because we're looking a little bit more positive. We're still negative overall, but we had a reading of 44.48. We get more into the neutral area when we get around 60 to 80 or so. So this is still leaning towards the more fearful side. This is showing pretty much the same chart that I show you, just looking at it in a different way. This is oil and how it's been really coming down. A lot of people really got screwed when they jumped into oil or the energy sector, even though it's been doing well. When a lot of people would have gotten into it, that's when it started not doing so well. This just shows that we have now a trend line right here. Can we break above that? Well, this trend line is actually coming down now below 100. Are we going to see oil continue to fall down into the mid to lower 90s? Here is the screenshot. This was taken after the close on Friday. It shows that large cap value, they weren't down as much. We saw a lot taken out as far as a percentage basis with the large cap growth. And that's why some of our charts are flat and didn't perform as well overall. But everything got hit pretty hard on Friday. Here's the VIX, where we really didn't turn up on a closing basis. And the bar chart is also continuing to fall as well. So we're not seeing an awful lot of fear coming in on a down day like we saw. The VIX of the VIX also continues to fall. It's just showing that the volatility of the VIX is decreasing. We did get an updated reading from the RIDEX bear bull ratio. Folks are getting a little bit more into the bullish funds now because they see things starting to go up, but they're not way down here at the bottom where they're excessively bullish. They're kind of in the midpoint right now. Here's the ulcer index on the daily chart showing that fear is really not happening. But here is an updated version of the weekly chart showing that as we've been going up, this line has been coming down. We're down 17.78% from the all-time high. The equity put call ratio did really advance on a one-day basis, and it started to turn back up with our 5-period moving average. Okay, here we go with the Fed watch. This is what we saw as of Friday, July 8th, 92.4% chance at a 75 basis point move. Then some economic reports came out, shoved it back closer to even. This is where we're at as of Friday. We're back into the 80% category. We still have a couple of days before the Fed makes their announcement. They start meeting on Tuesday, but they don't make their announcement until Wednesday. So if there's no economic reports coming out Monday. So it would have to be something happening on Tuesday economically that makes them change their stance. Support and resistance. Here are the pivot levels for Monday's session. And again, I'm assuming that you just pause this and might look at these values. Here's a daily chart showing how we did come down. We haven't really done a lot of damage yet. We haven't exceeded the recent lows that we've set. We're still above the daily pivot. We're kind of messing around with this gap area now, and that could be some pretty significant resistance. At the bottom, you see where volume dropped off to below average. Here are the daily pivot points showing we got up to R1. We tried to break above that. This is according to the DeMark pivot points, which he calculates his a little bit differently, where we ended up coming back down. Not a real lot of damage was done if you just look at the charts. Here is the Fibonacci level, where we're still above these two overlapping Fib retracement levels, but we're starting to get into some overhead resistance. And that could be really kind of negative for allowing prices to go higher. But boy, if we break through that, we'll take care of this gap and we'll get above this resistance level at the same time. That would be pretty positive. So you want to be watching. If the S&P is up, we're looking at about 40.19 to 40.20 or so. We got to 40.12 on Friday. We're still a ways away from that. Of course, we closed at 39.61. So we've got quite a bit of ways to go now. Our sectors, since we had a down day, communication did the worst. They were down almost 3.5%. Tech was down over 1%. These are the areas that have been really struggling in 2022. We had three areas up: staples, real estate, utilities. More of the value plays, more of the things that people have been getting into when they think the market is going to be having some trouble. So we kind of went back to our old ways on Friday. Are those old ways going to continue? That's the question. Here is the scooter rating showing that energy, utilities, and healthcare are into the 90s as far as their technical analysis score. And we have communication. Now it dropped below 10. It's down at 7.8. Here is a look at how energy is still up on the year. We have utilities just barely positive. Can't even really see anything there. All of the rest of the sectors are negative, where communication slipped into last place after Wednesday's session. Here's the indexes showing how the Dow is down. We have the pink, which is the S&P. We're still keeping an eye on the NASDAQ and the NASDAQ 100, and they got hit a bit harder on Friday. So that's why we saw things really come down. Technical alerts. They started out kind of positive. The energy sector went above 50. The S&P got above 4,000. Didn't last all that long. And there's nothing else with the S&P. And most of them turned more negative as the day went on. Here's our intraday chart. Not really much of a different open from the close on Thursday, but we saw some selling coming in. We dropped below. We tried to come back positive. That wasn't happening. Then this is when more selling came in. We dropped below the pivot, went down to S1, but we did see a bit of a recovery going into the close. Our trend still shows the ADX going down and below the moving average, but the green line is on top. The Arun still pegged, saying that buyers are in control while sellers continue to decrease. So our oscillator is still showing some improvement. Looking at breadth, we saw a negative day. So we saw a little bit of a tick down based on price and volume. Our advanced decline ratio, it's still positive, but it did decline a bit on Friday. New highs, new lows. This is still a little bit concerning. We saw a pickup in new lows. We have not seen a real increase in new highs as we've been going up. So this moving average is starting to roll over, where the 10-period moving average is starting to decline slightly. Accumulation distribution still looking okay, but we saw a bit of a downtick with Friday's move. Short term, we're still above the 20-period moving average, and those are starting to turn up now. We haven't seen that since back in March. But can we stay above these? That will really help the condition of our shorter term moving averages. I wanted to show this because we had the 5-day rate of change looking extreme. It's now dropped back down. Here's our short-term rainbow, where we're still up above the rainbow currently. Here's our moving average tree, showing that we're above the 20 and we're kind of dancing around with the 50 right now. The Stochc RSI starting to come down from extreme positive, as is the Williams percent R. The force index declined a little bit, but is still hanging in there. The Swinland trading oscillator declined a little bit based on price and volume. We'll want to keep an eye on this. This has been fairly good at leading the way recently. Can this turn around and go back up? McClellan oscillator, after giving us an extreme positive reading, has now dropped back down. We saw flat to downward movement with our 20, 50, and 200-day moving averages. The stochastics, they're still pretty extreme positive in the short term, turning down and looking extreme in the intermediate term, but the long term are still continuing to advance. Some intermediate term charts. Here's the 50, where we're right down to the 50-period exponential moving average. That's the blue one right here. The PMO continues to advance, both based on price and volume. The PMO studies, we're still kind of extreme positive with those PMOs that are rising. The buy signals are also getting extreme positive. We're still advancing slightly with those PMOs that are above zero. Chaikin oscillator didn't quite get to an extreme reading, but turned down nevertheless. Chaikin money flow also showing a little bit of weakness. The volume intensity, it's coming above the moving average now because we saw that one big up day on increased volume. That helped things as well. And now the average volume is starting to come down. So this is looking a little bit better on a relative basis. The vortex is still positive, even though it was flat with the buy side, it declined a little bit with the sell side. Summation index based on price, still advancing, based on volume, still going up. And volume has been kind of leading the way here. And that's a good sign. Why I have a blank chart here is beyond me. With our slope, we're trying to come back a little bit more positive, but the lines are kind of on top of each other. The MACD and all of the rest of our oscillators continue to be positive. Here's the BPI, where we just barely got above 50. Not very much of a bar right there, but still it did move up, and it picked that up in the morning with the positive move that we saw. The ease of movement is flat to slightly down with the 14 period. Ultimate oscillator, after being extreme positive, is now starting to come back down. Here's our intermediate term rainbow. We're still getting up into the underside of the rainbow. The CCI on 14 periods starting to come down from extreme positive, as is the 20, but they have a little ways to go. Money flow index also saw a bit of a decline, but still positive because we are above 50. Our itchy cloud coming into the underside of resistance here. And that is kind of playing into what we're seeing in the Fibonacci levels and other support and resistance levels. Here's another one with the percent B indicator where we're extreme positive. We got to the upper side of the Bollinger Band. Well, with Friday's decline, that is coming back down slightly. TTM squeeze, still hanging in there, has the more pale bars and they're advancing. And we're coming up to this 50-period anchored moving average, which is right about at where this gap is. So we've got some built-in resistance here. Our different charts, Heikin Ashi, still looking okay. Kegi, still looking okay. Renko, still looking positive. 3-line break, still looking positive. We actually added another X with the point and figure chart, and we have is this a triple top breakout potential? That's what it's picking up right here. And it drew that in the morning, and then we spent the rest of the day going down, but it wasn't enough to draw any zeros in the chart or even to take out that X. Our trading systems, we've gone back to neutral with the Elders impulse system, with the SPX and the SPY. We're still positive with the SAR. We're still working off of a positive signal with the go, no-go system. Long term, we still have a long ways to go to get back up into this rainbow. Sorry about that. With the longer term moving averages. 50 period came down just a little bit, kind of pretty much flat with the 150 and the 200. Special K still flat. We're back to neutral with the diamonds. And here is the Dow. We're still above the 50-period moving average right now. So we haven't done a lot of damage, at least yet. We're right down to this moving average, 65 period, and we've gone back to neutral with the Qs. And here are the Qs where we came up to the pivot level. Now we've dropped back down below R1. The Vixen also decreased on a down day, which is kind of surprising. The NASDAQ came up to R1, this pivot level, and coming back down, but still above the 50-period moving average. The mid caps also still above the 50-period moving average, even though they were down. The Wilshire was also down, still above the moving average. So we still see some positive potential here. The dollar was down slightly, but still in an overall uptrend. Gold ended up being up just 0.25%. It really spiked up at the beginning and then spent the rest of the day going down and closed near the low, where silver did close lower, down almost 1.5%. Here's the S&P to the dollar. And with these comparison charts or correlation charts, what I've done is I've tried to put some lines in here at the 0.25 positive and the negative 0.25. This, anytime we get a reading inside of this, that's what I consider neutral. Well, we're coming down to the point where the dollar and the S&P are going in opposite directions of each other. So for right now, we want to keep an eye on the dollar. I did, and it was down, but it didn't really give much support to stocks, but that did help things near the end of the day. Oil still down below 100. We've actually dropped below 95. We're at 94.70. Here's the correlation. Pretty much neutral right now between the S&P and oil. Looking at bonds, they were up 0.82% with the bond ETF, but still, my goodness, they could be building a base right here, but they have a long way to go to get back to a golden cross potential. Here's the world bond index. They also advanced up over 1%. So we're seeing some strength in the price of bonds. We still have two yield curves that are inverted. My goodness, inverted. 10 to the 5 is still negative, not a big deal. 10 to the 2, this is a big deal. And it's continuing to drop and get even more inverted right now. We're still watching the 10 to the 3 month. It continues to drop. If we get into this red area, that could be, at least a lot of economists might switch their tune about the fact that we're not going into a recession. Now they may suggest, yes, we are. So we're keeping an eye on this, and this continues to drop. Here's the tech sector to the 10-year. We are neutral. And just think of this. Think of the logic behind this. We are in a high inflationary environment where prices are really going up, but yet bonds are going down with their yields. This is why I've been saying, why is this happening? What does the bond market know that we don't know? Or what are they anticipating? In my mind, it looks like they're not as concerned about inflation as they were, or else we would see yields really going up right now, but that's just not happening. And then internationally, we're seeing a real drop where even the UK is dropping, even Germany, where they had a rate increase. See how interest rates are really coming down? And then Japan is still pretty much flat. Our scenarios, we're still holding up with the percent of S&P stocks above their 200-day simple moving average. We really didn't move all that much. The 10-day of the highs and lows, that's where we're seeing a little bit of weakness right now. We're in the highs and lows, and it's coming through a little bit to this chart. We did decline a bit. Here's the S&P stocks above their 50-period moving average. They're still holding up pretty well right now, as are the mid caps and the small caps as well. The equity put call ratio, looking at the longer term chart where we spiked up and are coming back down, well, because the equity put call ratio is going back up, this is starting to go up too. Are we going to go up and spike? That would mean we would see a real decrease in prices from here. As long as this keeps dropping, that will likely mean that stock prices are going up. Here's the small cap index. We're still above the 50-period moving average, even though we had a down day. The ratio between the small caps and the S&P did decline a little bit. So in our chart, we came down a little bit, but we still had a little bit of a spike here that we're working off of that may give some support to the S&P. Here's the S&P to the 10-year yield, also neutral. Here's the S&P to the 2-year yield. It is also neutral. The Copic curve is still hanging in there for right now. The bottom fisher starting to roll over, but is still giving us a signal. And then these are the charts showing where the Qs, they underperformed the S&P. So we dropped there. Discretionary, see how they still held up pretty well? The large cap growth against large cap value, they did decline. Here's some more growth to value ratios with the large cap decline, mid cap decline, small cap decline. So it was really the discretionary back here that held up the best. All right. Then looking at the 2-year yield, has it spiked and is it coming down? We don't know for right now. The staples sector has crossed over negative. There is a death cross in here somewhere, if you can see it, but we are starting to drop. There's a big conglomeration of price here. Are we going to continue to fall with the staples? That could suggest more positive action for the economy. We came back up a little bit with this spike, but we're not in danger of taking out the spike that we're working off of to give us some support for the S&P. All right, so what's our outlook then for Monday? The technicals, yeah, they're improving. They're turning positive, but we need buying to continue. We can't let this fizzle out, or we can't see this fizzle out. Sentiment is still moving more to the neutral area, even though it did decline a little bit more towards fear. We don't have any reports coming out on Monday, and then the whole list of events. And apparently things are kind of crazy in Italy right now, which historically, if you know much about World War II, when Italy had problems before, it led to some not very good things. I don't know if we're getting to that point necessarily, but the rest of Europe is sure keeping an eye on this. So we'd like things to be stable in Italy and in Germany. We don't want things that have happened before to possibly happen again, even though they are in different parts of the world, USA included. All right, so our scenarios are we going to go down from here? Well, we could for any one of these reasons that are listed right here. The technicals, but they're improving. We're still seeing improvement overall. So they're looking better and turning positive, and you still have a disbelief that the market is going to go higher. Our scenarios, they're still holding up. They're still above the moving averages with our sector rotation. Our positive setups, they're not negated at this point. The technicals are showing a lot of improvement. We're still above the 20-period moving average. We're dealing with the 50-period. Can we get above those? And we're still pretty much sideways in an official capacity because the ADX is below 20, but it is positive. So our conclusion then is the S&P is improving. Can it continue? Short term, we need buyers to keep coming in. The same thing with the intermediate term. But we're not going to see the intermediate and long term improve until the short term keeps up the positive action that we saw throughout last week. So thank you. Have a wonderful weekend. I will prepare the weekly video and the intermarket analysis video. We're not really seeing a lot of changes in the intermarket video yet, but things are starting to look like they could be shifting. We're seeing what has been really positive, seeing some weakness. So feel free to look for that, and I'll probably prepare that over the weekend.